If you're trying to build wealth using stock market, you are at the right place. Welcome to Paradigm Shift. My name is Patrick Barfi. Here we teach you how to dramatically improve the quality of your life. Today we're going to talk about how to fast track wealth building with the stock market, for beginners. Yeah, it is true. You can build wealth using the stock market. But before we start, I want you to like, share, and subscribe. Like, share, and subscribe. Um, so yes, how to fast track your wealth building with stock market for beginners. That's what we're talking about today. So why should we even use stock market to build wealth? So why should we invest in stocks? Two things: time and, let's say, um, the value. What we've seen is, even though the stock market goes down and up, at the long run, it appreciates big time. As I'm talking right now, when we look at the past 100 years, the stock market has been averaging about 10.49, almost 10.5. With all this that has been going on. So let's look at it. So that tells us that with time, it goes up. No two ways about that. It goes up with time. So let's go back and look at the past 100 years and see how it has been traded for. So let's go all the way to 1930. The stock market was, the Dow Jones was trading at 225 points, all the way to 1960, which is 30 years. It doubled, almost double, right? Or I think it doubled, more than double, right? So it was trading at that time at 618 points, all the way 1990. I think it quadrupled from 618 points to 2,679 points. And all the way for another 30 years, that's 2020. It went from, wow, almost 10 times, 26,890 points from 2,674 points. You see, if you notice, even with all these things that happen in 2029, 2028, how, it was cut in half, it still came back, and some more, from 2,679 points all the way to 26,000. And guess what? Today, as I'm talking right now, I think it's about 42,000. Let's say it's around 42,000 up, right? That is a period of about 5 years. So everything that happened during COVID, where people were talking about a lot of things, and look at it this way: anytime anything happens, people talk. Like, this time is different, and the stock market is not coming back. So what we've seen is, a long run, it goes up. So that means it's good. You can use that to build wealth. And there's a good track record. You can see it for yourself, right? So that is why you can build wealth through the stock market. But before then, why does the stock market even exist? Why do we have the stock market? Why does it exist? So let's say have a company, right? Have a company called Bar Foods. We do sell groceries online, both Caribbean and African goods. We ship it around all the country, And let's say I want to expand it, and I don't want to go for a loan. Or maybe I've even gone for a loan and they won't even give me more. Or I don't want to go for a loan anymore. What I can do is, I can take that company to to the public. And how do you do that? You take it to the public by initiating IPO, which is initial um, public offering. That is IPO. And what I would do is I would take my company and divide it in pieces. Like, let's say I divided it in 200 pieces. And let's say, and each one is called a share. So let's say each one is $20. And the division is about 200. So what I can do is I can raise capital by giving you a share and you giving me money. And you risking your money. If I do well, the company goes on well, that share appreciates, and you also that means your money is appreciating. So the stock market is the place where we can go raise capital. One of the things we can go raise capital for our companies. Yeah, it's fine. Sometimes you can, just because some people just put their money in their pocket, but most of the time they put it back in the company to make sure the company is doing well. So how do we buy stocks? How do we buy stocks? You see, you can only buy stocks. You can only buy stocks and sell stocks with public traded companies. See, the company should be a public traded, like I said, by filing for IPO. That means it has become public. Not all companies want to go public. Like, there are some companies that are big a little bit, but they don't want to go public. Like Chick-fil-A, it's not a public company. So you can't just go public and go get it. But what you can do, if they want to sell it to the public, they have to file for IPO and come there. So we can only buy shares when these companies are public. And you need to have a brokerage, like Schwab's, Vanguard, Fidelity, or maybe these one, Robinhood or Stash. Not long ago, it was this, white old man with tie. It was hard to get to buy a stock and it was expensive. And these days they've made it so not long ago. They've made it so easily. You can even just go to these apps and start buying. So you're getting a piece of that company by paying a fee, or not a fee, by paying for that share. These days you can buy even a piece of that share. You don't have to even get a whole share. So these platforms have made it so simple for you to get it. So these are how you can get it. And if you are doing it, also you need time. Time is generally you can only buy and sell stocks between 9:30 a.m. to 4 p.m. Eastern Standard Time. And like I said, it has to be public. You can't just walk in and buy. So you need a stock brokerage, which are these companies that you can go through and making sure the time frame, and also if the company is public. Those are the things we need. And so how do we make, let's say if we get it, how do we make money out of these companies? See, there are two ways you can make money out of stocks, which is appreciation and dividend. You see, appreciation is when you have, when you buy a stock, you buy a stock for maybe $50 and it goes up to $60. Simple. And dividends is when a company is paying you for just owning it, So there are some companies that pay both. You get appreciation and also get you dividends. That's not what we are talking today, but and there are some companies that only you can only profit from the shares appreciating. Yes. So the appreciation or the dividend part is just you just doing that, and they get you, they put money in your account all the time, like every 3 months or whatever, for you to get it. The next one is, let's see how what moves stocks up and down. You see, it doesn't matter what it is, whether it's real estate, whatever it is. It's demand and supply that moves, prices up and down. On the supply side, like I said, these companies put their shares out there. So they take a piece of the whole company, divide it, and they put it out there. That cannot be controlled. That doesn't really change much because what they have is what is in the market. But at the same time, too, sometimes they can change it. Recently, I think Coca-Cola changed it by dividing, they call it stock split, by dividing that one stocks into 10. So if you own a stock, which is Coca-Cola stock, for just one, which is $10, they divided it into 10 pieces. The value didn't go anywhere. The value is still the same. By the shares multiplies. So now, even though you have one that has been divided into 10, each share of the division is also $1. So the value is still the same, but a lot of shares came out of it. So that doesn't change. But the demand side is where usually that's where the issue is, because what it is if companies start reporting of they're trying to increase profits, they put in more money in the company and all that, people get excited and they started buying it. At the same time, the opposite side, if the companies are not doing anything, they are, the people see they are no future, investors don't want to buy, it can drop that. But sometimes we've seen the other way around, where even though this company at this time is doing very good, they doing everything right, but if people don't see that there's a future in it, they won't participate. So these are some of the things, and the other things like inflation and all that can also let it go up and down. So let's say, for instance, when we talk about the dividend part, Home Depot. Let's take Home Depot for example. Home Depot, and let's say the appreciation part and the dividend part. Home Depot was trading as of 2024, the beginning of 2024, for 331.80 cents, right? By the close of 2024, it was 384.15 cents. That has appreciation part. But at the same time, they also had a dividend. They put out dividend for their shareholders in March of 2024, which was $9, and additional 2.25 in the third quarter. So that's how you make money in there. So now that we've gone all this, we've taken this out of the way, what are the strategies that we can use? Because you can't just go into the stock market and start buying anything. You have to know what you're really doing. What are the strategies we can use? You see, what we have to realize is the stock markets every investing is risky and never guaranteed to make any money. That is what you have to understand, that. And the stock market goes up and down. Like I was saying, at the long run, yes, you're going to make money. But you need to understand that sometimes it's going to go up and sometimes it's going to go down. And what are the strategies are you going to use that is going to make you stay in there? So there are two strategies that I think it might help. What we have, the passive and the active. The passive is you setting up and let it just forget it. So something like, hey, I know what I'm buying. Every month or every week or every 2 weeks, I'm just putting maybe 200 in there, like a dollar cost averaging type. You set it and forget it. And the passive side, you don't do much, but the active side, you have to be more involved. I'm not talking of trading. I'm talking of you being able to read the financial statement of the company, depending on those things. So usually the passive side might be a fund. In that situation, if you're doing a fund, you're not buying just one company. You're buying a basket of companies, a whole lot of them, about 500, about 2,000. And that usually, the passive side, which a fund, you don't do much. Like I said, they do everything for you. They do everything for you. All you got to do is pay just a fee, and they will do everything for you. So let's talk more about fund, right? How to understand fund and also the different types of fund. We have different types of fund. We have index fund, we have mutual fund, and we do have ETFs. So when you talk about fund, there's three things that you have to understand. One should be the fee and how many times it can be traded. and the next thing is the minimum amount that you can invest in. So let's start with index fund. Index fund is usually controlled by algorithms and computer. So you don't have to do a lot. All you got to do is just buy it, and everything the algorithm and the computer is going to do everything for you. So you don't have to do it. All you got to do is know what you're buying, the type you're buying, and it's going to do for you. So let's look, for example, and because somebody is computer doing it for you, the fee is very, very low. So usually index funds got a low fee, and it can be traded once, and minimum payments, yes, there are minimum payments. So let's take VFIAX, that's the S&P 500 of Vanguard. That is the expand ratio, which is the fee, is 0.4. You can't beat that. That means every dollar you paying 4 cents. Fee is very key when you invest in, because if you paying a lot, it can either way your profit or it can either way your money, and it can be traded once, and the minimum that you have to start with is 3,000. All right, so let's go to mutual fund. Let's see, mutual fund is also because technically mutual fund is most fund track the S&P 500. So the goal is to beat S&P 500. And mutual funds are being run by a fund manager. And since it's being run by a fund manager, you pay more for it, because what all the fund manager is trying to do is trying to beat the S&P 500. But guess what? Study shows that a lot of fund managers don't beat the S&P 500, yet we pay a lot for them to try and money to beat it. So that is it. So mutual funds, you pay more on a fee, and it can be traded once, and also got a fee, got a minimum payment. So when we take one of them, for example, mutual fund, with a low fee of hold on, let me see. Mutual fund is, let's use one example as the T. Rowe Price Global Value Equity Fund. It's 1.09% as a fee, and that's very huge. Even just 1% is very huge, because if you're doing this for a period of 30 years, imagine how much it's going to go. We'll come to that, and it can be treated as once a day, and the minimum payment is 2,500, right? So let's see. The next one is that these are the funds. So this is not just one stocks. And see, a lot of us, we don't really need to go into single stocks. The fund is doing everything for you. You don't have to do much, right? So you just watch the fee and do that. So S&P 5, let's say ETFs can be high or low, because we have ETFs. ETF can be index or mutual. And the thing about ETFs is it can be traded like stock. It's unlimited, and there are no funds. So usually it's easy to do ETFs. So let's take SPIA, for instance. It's S&P 500 ETF Trust, which is 0.9% unlimited, trading, and no fund. So these are the fund, and it's so good because what it is you're not just buying one stock, and they are doing everything for you. You don't have to rely on all these research and all that, because trying to invest in single stock, you need to do a lot, and we're just about to go there. How do we analyze single stocks? You see, single stocks, like I said, is good, is very good, but single stocks, you need to do more. You need to do more. All right, so let's take McDonald's. For the purposes of this video, we're going to take McDonald's and Coca-Cola. Right, you take McDonald's and Coca-Cola. As of today, McDonald's was trading as 304 per share. Coca-Cola was trading 71 shares. So let's say if you're trying to do a single stock, you need to know the difference. You need to know, but you cannot just go by just the share value. See, the share price is the value of the company's share divided by the number of shares. So that alone won't tell you if that company is good. The fact that the share price is high, you don't use that. That's when we come to the market capitalization. The market capitalization is we have to know the value of it. And how do we do that? Like I said, as I'm talking right now, the market capitalization of McDonald's which is Mickey D, which is 220 billion. Coca-Cola is almost 10 billion. See, yes, it's about 10 times, more than 10 times. Mickey D is more than 10 times Coke. But even that still won't tell you if it's the best one for you to invest in. So we have to look at the PE ratio, which is also how the company is being traded, how many times it's being traded for each profit, right? So the PE ratio for Mickey D is 27.62, which is, and Coke is 17.52. See, under normal circumstances, generally a lower PE ratio is better. But like I said, you can do some more analysis and find out what is better for you. You see, the EP ratio is just a price to earning ratio. It's a price to earning ratio. It's a value metric that compares companies' stock prices to its earning per share. So how many times it's being traded for the profit? This helps investors to know if a company is valued down or valued up. Usually, if it's high, it means it's valued up. If it's low, it means it's valued low. And all these, you have to go through all these to be able to know. So don't just follow the crowd. Like I said, it's nice. And you see, because you are more involved, usually stock, single stocks gives you more potential, more profit. Like I said, S&P 500 has been averaging about 10.5 for the past 100 years. You might take a single stock like Nvidia. We just saw what happened in Nvidia even last year. It was so nice, but you need to know what you're doing. You can't just start investing because everybody is investing in, right? So we have to go down and see all these things, So the PE ratio, like I said, it depends on the value. So let's say the value of the stock, to be able to know the value. If it's trading, let's say I have shares of 1,000 for Mickey D times 2,027. That means I have the share. That means the company is valued at 2,700. The same way the other way is the company is valued at 17,000 if you have 1,000 share. But like I said, it's still tough even to tell if it's good for you. So that is when you have to be able to know how to read the statement, the company's financial statement, their balance sheet, and all those things. Like I said, most of us, we don't have any business doing those stocks. You can just go through the fund, and the fund is going to do everything for you, especially in the index fund. It's done by algorithms and computers. So let's take the S&P 500, for example. If anything happens, they have a standard they have to be in. They have criteria you have to be in. If anything happens, that computer or whatever algorithm is going to kick that person out or that company out. If that company is not doing good, it's not meeting the standard, it kicks them and bring another one in. So you don't have to do much. All you got to do is dollar cost averaging when you're doing a fund. But if you're doing a standard stocks, you need to understand what you're doing. You need to know all these things before you can do a single stock. So yes, single stocks are good. Like I said, it's good. But if you don't know how to do it, sometimes it becomes like I would say like a lottery or something. Like it's so risky doing single stocks if you don't know what you're doing. Somebody might say, hey, okay, if it start dropping, I just, take myself out of it. No, it's hard when realizing that you're making a lot of money. It's just like crypto, you're making a lot of money from 1,000 all the way to 100,000. And it comes down 90,000. Are you going to take it? No, it's going to go up. So it becomes your habit. That is why if you really don't know what you're doing, you can't study all this and see the future of the company. You don't focus on single stock. I mean, you can do just a portion of it, a little bit of it, but usually what you want to do is invest more in funds. That is what is going to help you to build wealth, or fast track build your wealth using stock market. At the same time, people have said, hey, yes, these companies, the way it is, it's going to be hard for these companies to come down. I always refer people to CS. CS was one of the largest sales company, on planet, period. And where is CS now? So don't say, hey, Amazon is too, the way Amazon is going, it's never going to come down. No, you can't say that. So my advice, like I said, I just provide this and you go through this and see what you want to do. But I prefer fun. Just a small portion of my money goes to single stocks. So after all this, how do we avoid mistakes? Because there are a lot of mistakes when it comes to, especially when you're a beginner. How do we avoid that? Say, for the past 100 years, we've had a lot, about 25 stock market crash. We've had about 16 recessions. Stock goes up and, stock goes down. That is part of it. That is part of it. So when this happens, people start to shake. They start to panic and they start to sell. You see, I'll go by saying this quote that Warren Buffett always said. I'm going to paraphrase it. It says, the stock market is the place that the patient take money from the impatient. He says it's the place that money transfer from impatience to patient. So anytime something like this start happening, people just panic. And when they panic, what do? They sell. And sometimes they undersell. And those that are very patient, they will buy it. And what happens? Over and over again, like 100 years ago, up to this time, we've had 25 downturns. We've had 16 recessions. But look at the numbers again. Let's go all the way back to since 1930, right? From 1930, look at the trade. From 1930, it was 200 and the Dow Jones was trading at 225 points. As I'm talking right now, it's over 442,000. So it tells you that anything that happens is still going to go up. Do not rely on what people say. Don't listen to the noise. Just cut the noise and continue investing. The stock goes up and it comes down. It's part of it. It's part of it. So don't rely too much on those things. Just cut the noise and continue doing what you're doing, because yes, it's go down and it's going to come back again. You see, I always say that the stock market is the only store when it's on sale, then everyone runs. We know when these stores are having sales, we all run in to get it. But when it's on sale, the stock market is on sale, then everybody's getting out of the store. So if you are patient, you buy more. My advice, if the stock market is going down, buy more, because they will have a way of telling you that whatever is happening right now is different from what happened 20 years ago. And this time, it's not coming up again. Yes, the tariffs is different from the housing that brought us all down. Tariffs is different. The stock market is gone. It's not coming again. You see? Oh, the housing bubble is different from the 2001. Don't listen to that noise. Continue buying. Continue to buy. All right. Next one, check your fees. These are the mistakes. Check the fees. Check the fees. It's very important. Like I said, if you can't do anything, just put in an index. Cheap index one, like we saw, the VFAX, which is the S&P 500 Vanguard Fund Admiral share, is 0.04%. Study shows that if you pay just 1% over a period of about 25, 30 years, it's going to knock away about 25% of your total investment portfolio. Gradually go, because remember, if you pay 1% and you have 25,000 now, how much are you going to pay? You're still going to pay 1% of if it gets to 100,000. So 1% of 10,000 is what? Just $100. 1% of 10,000, 100,000 is what? 1,000. So before you realize, so watch that. It's very important. You watch that. The next one is, don't put all your money. You don't put all your money in one stock. I think I've said enough about that. Because yes, these stocks, single stocks are good. Oh my God. Oh, it's nice. Last year, we all saw what happened in NVIDIA. Come on. It was rocking. But be careful. Be careful, because when it becomes your habit, it's going to knock you down. So like I said, yeah, you can do it, just a portion of it, a little bit of it. Yeah, because when you see the numbers, it's going to, let you go there. But be careful. Do not put all your money in one stock. Fun is good, because a basket of them, we have 2,000. We have the whole stock market. You can buy a whole of that, right? And also, we have to invest more than you are willing to lose. Do not do that. Only invest the money left. After everything that you've done, the money left, that's what you invest. If you're using your brokerage account to pay for your mortgage, to pay for your food, to pay for your whatever, you are doing it all wrong. Yes, you are doing it all wrong. If you are using just that to know, you are doing it wrong. Make sure whatever is invested is gone. Forget about it. Let it go. And hoping it's going to grow, so that by the time you need it, or by the time maybe you retire or you need it for something, it's there for you. But, cutting it short and using that, you're doing it the wrong way. You are doing it the wrong way. You see, I always say you might want to make sure you go with a strategy. Every money you make, we spend 70%, you save 10 and invest 15%. In that situation, you know what you have. You know your savings, you know your investment, and you know your spending money. Do not put all the 100% in there and go back and take it out. No, don't do that. And even with a saving, when you start saving 10%, it might be a point where you don't need to save anymore, because most of us we do savings wrong too. If you don't have a name for the saving, it doesn't have to be. You don't need to be saving that money. That money needs to be invested. So if you want to invest, or if you want to save for, let's say, your emergency fund, you need about 30,000. When you get to the emergency fund, the rest, instead of saving, continue to save, you invest it. Remember, saving, we are not investing saving. We just put it in an IRA account because we need that, right? So if you don't have a name for it, you don't have to save it. It has to go to investment. If you have a plan for it, boom, it's going. Don't put all the money in and go back and take it. So make sure everything that goes in is gone until the time you need it, right? Yes, so if you invest in using your brokerage account like a checking account, you're doing it all wrong. Be inconsistent. You see, most people are not making money through their investment, not because they didn't put money in there, not because maybe the rates, the profit that is coming on. No, it's because they did not invest their money. Yes, there are so many people that are inconsistent. What they do is, they invest 1, 2, or then they stop the next year. Now it's going up. Then they come back and do it again. They come back and do it again. Now, you can't do that consistently. You see, if you start from 25 and you put in $100 and getting a rate of about 10.5, you probably have $1 million by the time you retire. By the time you retire about 65 or so. But if you cut it short, you won't get that money. You do it 10 years, you stop, you come back and you won't get that money. So you have to be consistent. Dollar cost averaging. If it's $20, but even if you invest in $100 and you're doing $100 for 10 years, 20 years, that is still a failure, because what it is, that means you never get a raise in your life. So that means that money is still going to go up. But it has to be consistent. You have to be consistent. That is how you can win the race when it comes to investing or building wealth using the stock market. See, we're hoping that, all you continue to do is start trying to buy more assets and trying to build and build and build to a point where that money is going to make you more money. Yes, it's true. You can build wealth using the stock market. but you have to go through step by step what I'm saying. If you're not consistent, no, it won't happen. Yes, you can build it. My name is Patrick Buffy. Make sure you spend wisely, save intentionally, and be generous. See ya.